Good morning, Richard Calhoun, Creekside Realty, real estate broker in Silicon Valley for the last 40 years. We're here to talk about the real estate market in the last week and then also hit the monthly data since this is the second Saturday of the month. So I've changed the order of the slides a little bit. We're going to start off with some stuff. I think it's going to make an executive summary quicker and easier. So basically, we're going to start off with sale price in the different micro market areas. The bluer the color, the more affordable it is. The redder the area, the more expensive the area is. It's compared to the median, which is almost always going to be Redwood City. I put this first because it's sort of a lagging indicator. Now we move into overbidding. This is the sale price to list price ratio, the average of that for all the transactions. So the pinker the area, the redder the area, the more the overbidding. So some of the higher areas you can see are in Milpitas here at 106% essentially, and then followed by Cupertino at about 104%, followed by Campbell at about 103%, followed by Morgan Hill. So basically, as the colors go down in intensity, the degree of overbidding, the magnitude of overbidding is less. The blue color indicates that you're getting less than 100%. You can see that it's at 98%. At the bottom here is the range. So 100% equals no color, 96.5% is saturated blue, 110% is saturated red. This should be blue. I think it should be a lighter shade of blue, so I am going to investigate that, but that's what I have for now. Moving on to the frequency of overbidding, this is how often, how many sellers are getting more than their asking price. It could be a penny over their asking price, or it could be $1 billion over their asking price. So it's just whether it's above or below. And again, at 42.5%, there's no color. 20%, it's saturated blue. And at 75%, it's saturated in red. You might ask why at 20%, with 20% of the sellers overbidding, why would that be saturated as a cold marketplace? It's just the way the real estate industry is. Even when we were in the recession after 9/11 and after the mortgage meltdown, you didn't get below 15%. Some sellers won't take a penny less. They price it aggressively and they hold out for price. So it's just the way the market works out. So again, the redder the marketplace, the hotter it is. And now we move up to days of unsold inventory. This is the most current data. This is based on the rate of sales. So and what's interesting is down here in South County, you have a super red area, but if you go back to the previous slides, the overbidding isn't there. And that's just because historically Morgan Hill hasn't been as a competitive marketplace. So even though right now their inventory is moving very quickly, the industry down there, the community down there just isn't set up to overbid. And so the amount of overbidding on the previous slides is a paler pink, where you would have expected it to be a deep red like this. And again, you can see consistently up here in Menlo Park, Atherton, it's the lighter color. It's at 77 days, so it should be a slight hint of blue to that area. And I might agree that it's a slight hint of blue. Now we're moving on to each of the micro markets. And the concept here is this is days of unsold inventory. The lower the days of unsold inventory, the hotter the marketplace is. So as you get up to current day, which is here on the 14th, are these lines going up or are they going down? If they're going down, that's actually an improving marketplace. If they're going up, that's a slowing down of the marketplace. In general, the long-term drift is slightly up. Here, there's definitely some areas that are basically flat. There's some micro market areas here that are clearly up, and there's a couple here that are coming down. So it depends on what's happening in each area, which is why I follow the different micro market areas. This is I think a new slide. I might have had it up last week, but what I'm looking at is the days of unsold inventory is the blue. So the blue line is the current data. The gold line is the last 5-year median. And what I'm looking at is whether the days of unsold inventory increased and by how many days over the previous week. So back here on the 5-year median, and this is pretty dramatic, we went from a 1-day decrease to probably an 11-day increase. So days of unsold inventory increased 11 days in the 7-day period of time. That's pretty dramatic. When you have this and you go back and look at it, that's associated with a holiday almost all the time, which is why even though it's a very squiggly line, the blue line and the gold line tend to follow exactly on top of one another. Now here you might argue we're shifted by 1 week, but that's probably Labor Day, if I remember correctly, because this year Labor Day was as late as it possibly could be. So it fell into week 36, where it normally falls into week 35. So it gets shifted by 1 week. I'm not sure I can tell a whole lot about that, but what you can really see is something happened here. Well, what happened during week number 10? Week number 10 was shelter in place announcement. So this is the aftermath where days of unsold inventory this year went up dramatically, and normally it would not be going up at that time of the year. Then you could see these big changes, and I think this is probably related to announcing that we could show vacant property, and probably related to announcing we could show occupied properties. So you can see how the market responds very rapidly. Now you're looking at just the data, which is the more normal way. So the blue line is the current data, the gold line is the 5-year median, and the red line is the percentage. So you can see right here, we've been below the gold line for most of this period of time, which is why the red line is sitting here down at about 80%. But now if you come out right to here, you can see last week we caught up to the gold line, and this week we fell down just like the gold line did. So for the last 2 weeks, we've been at days of unsold inventory, been at exactly normal for this time of the year. Now do keep in mind the last 5 years have been 5 great years, very fast active years. So it would imply that 2020 is a fast active year. Now we're looking at the different components. The blue line in this case is the total available inventory on a percentage basis. So right now we have 120% of the current total inventory available compared to the past 5 years. So the people that are complaining that there's no inventory, they're a little out of touch with reality when you're looking at the macro market being Santa Clara, San Mateo County, single family homes and condos and townhouses, because right now there's 20% more homes available for a buyer to pick from than there is normally at this time of the year. Back here, you were right at normal. So this whole year you've had normal inventory, and yet I consistently hear there's a lack of inventory, there's a lack of inventory, there's a lack of inventory. There is not a lack of inventory based on the last 5 years. Now, historically, yeah, maybe there is a lack of inventory, but we've been shrinking down in size for many years, decades actually, at least since about 98. The volume of transactions year after year after year goes down, even when the market's strong. Moving on to new listings for the week, that's going to be the brown line, and you can see that is up fairly dramatically. If you look at it, you were down back here in shelter in place. We were sitting here right about 100%. You had a little bit of a fluctuation because Labor Day was later. Also, holidays aren't impacting the market as much as in the negative direction as they normally do, because people aren't going on the family outings or staying home because of shelter in place. But now, basically, starting at week 37, you were getting 20% more listings, and now for the last 4 weeks, you've been having 40% more listings coming on the market every week than normally come on. So basically what it's saying, in my opinion, is the end of the year slowdown in activity is not happening with respect to the number of new listings coming on the marketplace. But then you look at the number of sales, which is the gray lines, offers accepted. It basically came up to 20%, but it's staying at 20%. So because it's staying essentially at 20% and your new inventory is at 40%, that's what's causing this available inventory to actually increase, because the new sellers coming on the market are greater than the new buyers coming on the marketplace. So we're not in an end balance in that direction yet, but that is the direction we're going. Now we look at the number of active listings currently on the marketplace without an offer. So this is what I call total inventory. This differs from most people. Most people include some of what's in the escrow, the pending continue to show. I think that's very deceiving. I think that's how you get garbage when you start looking at statistics. But again, if you look at the total inventory, the blue line, the current data for 2020 has been right on top of the gold line, right up here until about week 39. And now you can see there's been a marked separation. And the difference is normally at this time of the year, available inventory starts dropping off. This year, it's been basically fairly flat. There's been a slight drop off, but nothing dramatic, not like it normally is. That's causing the ratio to increase. And you can see right now, we're at 120% of the inventory that we normally have. Moving on to looking at the number of new listings in the given week, you can see the blue line. The number of new listings is coming down, but it should be coming down dramatically on this orange line. So what it actually looks like to me is maybe it's delayed by about 4 weeks, 1 week, 2 weeks, 3 weeks, 4 weeks. And, this is probably, again, a calendar shift. It's probably back to, yeah, so this is after Memorial Day, Labor Day. So this is probably the Labor Day, this big spike here. So this is like 2 weeks after. So it's just the recovery afterwards. But normally it falls down. It's delayed a little bit. It's following the normal trend. In fact, if you look at it, this line, the blue line, the current data for up to here has been more dramatic than this gold line. The thing that's interesting is these two data points. I do not believe that is a data error. I will look into it. They do not look like they're completely equal. It looks like it's down a little bit, but you have almost as much inventory this week as we did last week, where you would have expected it to drop down fairly significantly. And that's, again, why this percentage ratio went up fairly dramatically. Now, do keep in mind, well, the new listings is actually fairly accurate information, so I'll hold that off. Offers accepted during the past week. This is, again, the same concept. The blue line is the current data. The gold line is the 5-year median. The red is the average. You can see, for the most part, back here, the blue line was negatively impacted by shelter in place. It came up. It was doing fairly normally. It was above the gold line, so that meant we were having more transactions than normal, and that's why the red line is above the 100% horizontal red line here. And now you can see that we're still above. So we're selling basically 20% more homes than we normally do. And that's okay when you're having 20% more listings coming on the marketplace. Right now, as I said earlier, we're getting 40% new listings coming on the marketplace. So if you're only selling 20% more, you're going to start getting the inventory to build up. On this particular slide, I broke it down. So now we're looking at only the frequency of overbidding. And you can see it clearly has come down a little bit these last last week, and the weeks before that it was pretty flat. So basically what this tells you is somewhere around, this is going to be 50%, 55, 60, right at 60% of the sellers are getting more than their asking price. The purple horizontal line is shelter in place. Now I'm flipping over to the micro market, so you can look at what's happening in each one of the micro market areas, and you can see that some of these areas are still up. And in fact, if you look at the red line, which is Santa Clara County single family homes, it's increasing. So that means there's some other areas where it's decreasing, and you can see some of the lines down here, and you'd have to go back up and pick up which areas those are. But that shows you that not all the areas, even within Santa Clara County and San Mateo County, go in the same direction at the same time. Now we're looking at the other half of the slide. I just broke the two apart, and now you're looking at magnitude. You can see the magnitude of overbidding has come down for the last couple weeks now. The peak is probably right here. So here you can see what's sort of the peak, and we've been drifting down. Now remember, that is magnitude of overbidding, which means we have to have sale price, which means you have to have the close of escrow, which means that this is lagging by about 5 weeks. So the market actually turned about 9 weeks ago. A lot of people that are out there are looking at would not see that. But again, this is macro data, not any different individual micro market areas. So now you look at the micro market areas, and you look at Santa Clara County, the red line back here, it's clearly going up. So county-wide, the average is going up, the magnitude of overbidding. But then you look at this gold line here, and it's coming way down. And I don't know which area that is right off the top of my head. It might be San Mateo County condos in the north area, but it's hard to tell. And that's one of the reasons I shouldn't diverge like that. This is the overbidding for each week. And even though I have the 13th, I did go ahead and update it for the data for the 14th. I just didn't do it. Update the data point. So you can see the dotted lines are the oldest. Then come the dashed lines, and then come the solid lines. So you can see the yellow solid line, which was October 23rd, is basically when we had the best distribution. This was when the market was the most aggressive, and that's again for closings. So now if you back up 5 weeks from that for the duration of escrow, basically somewhere just before the Labor Day weekend at the end of August. Well, the Labor Day weekend was in September 6th, I believe. So 2 weeks before that is basically when we were at the peak of the marketplace. We're not cooling off dramatically, but you can see the downward trend. The red line is the most current data. Now what we're doing is we're putting that in perspective for the last 20 weeks. And it's the same concept. What I've added here is the outliers. The best April which is going to be this dotted line out here, and the worst December, which is the further down blue line, they're definitely not updated. I may have updated the worst November and the best November, which are the next sets in. When I said updated, I hit up until right now, basically, I've been using single family homes only for this data. I'm now doing this for the macro data so we can see what's happening. So again, all these data points inside are Santa Clara County, San Mateo County, condos, townhouses, and single family homes. And it's since July the 3rd. And what you can see again is the dotted lines are back here. They're the oldest. Then you go to the solid dashed lines, and then you go to the solid lines. But now if you look at it, the red line is getting towards the bottom of the solid lines. And basically what it's saying and showing is basically September 26th, October 3rd, we're basically down here. Then it kept improving, and now we're worse. So this is the worst week we've had in the last several weeks. It's still pretty good. It's one of the, it's still in the middle of the pack for the year, or for the last 20 weeks. But you can see that every single week that you go up and down, and you can see whether the market's getting hotter or colder. Here it is now, where we're looking at single family homes in Santa Clara County only. So what I'm here breaking out is going, that was macro data. Now let's just look at the single biggest micro market and what's happening. You're now, the red line, the current line is on top. And what I'm showing here is years. So based on the last 12 years, this is the second best year we've had. The only year that's better than the year we're having right now was 2017, which was just an outlier year in every way. So you're having a very strong year. You can see here at the very high end, you're not coming up as strong as you'd expect compared to down here. And that's because when you have an insult, which shelter in place is an insult to the marketplace, buyers are a little more conservative with their money, so they're not willing to go up like here. And that's why it gets a little bit more bloated down here and then gets flat, because these people just are resistant to overpay. So you can see the resistance really starts hitting at about 5% above asking price, where normally it doesn't start hitting until maybe 10% above asking price. So it's just a shift in the psychology of the buyers. It means it's more important for a seller to price their home properly initially. And now we've just added in 24 years, and you can see basically the older years, the dotted lines are some of the worst. They get up here, that's somewhat respectable here, and a respectable line under here. Then the dashed lines are sort of spread out. The solid lines are spread out. But that's just so you can see which are the better years and which are the worst years. But again, the takeaway is the red line, the current year, 2020, is the best year. Now, just for the record, 2020 is not all of November. So all these other lines are macro data for November 1st through December the 5th. The red line, since we're trying to figure out what's happening just in the last week, is just the last week. So it's basically November the 7th through November the 13th at midnight. So, I'm looking at what the last week's data has done. And that hits it with the summary for the weekly data. So I'll pause and see if there's any questions before I jump over and look at the monthly data. So now we're looking at the monthly data. This is the month of October. My October starts on October 1st, includes 35 days. So there's 31 days in October. So it included the first 4 days in November. I collected the data on November the 5th. The highlighted area colors are the more important ones, and we'll see some of these graphically. But if you look at inventory, you can see at the beginning, on November the 5th, we were 883 single-family homes in Santa Clara County. You can see that is actually fairly low. How can that be low when I'm talking about more inventory? Well, the areas that are getting hit the hardest with shelter in place are condos and townhouses and convenient commutes. So Santa Clara County is sort of a secondary area. We have Morgan Hill, we have Evergreen area, we have Milpitas, North Valley. We have areas that are further away from the job centers. So the areas that are getting hit right now are condos and townhouses because of the lack of privacy. People want a little more space around them, and San Mateo County. So when you're in Santa Clara County and looking at just Santa Clara County single family home data, it's a totally different marketplace, which is one of the reasons I look at it so differently. So even though my inventory is up 20%, single family homes in Santa Clara County are not up 20%. In fact, they're probably down. Yes, there are some years like here in 2017 when it was actually lower. It looks like that's 618 versus 883, I believe the number is. But it's also quite a bit lower than last year, 19, 18, 16, 15, so you have to be careful on when making sure you're doing your valid comparisons. Then you look at the number of sales during that period of time. And this year you're at 1196, and I update it. The updated number is to sort of compensate for people that report the sales late. Now, I don't go back, and you can see I've got 44 additional transactions. I don't add those 44 transactions into this data point, but it's just an idea of how big the total package is. It also has transactions that fall through. So if you go back to these previous years, like 940 to 918, you can see the numbers actually gone down. That's because after you've been on for 5-6 weeks, the transactions that are going to fail come out of this number. So, but if you look at either one of these numbers, we've had more activity in Santa Clara County than we've had in any of the recent years. You come down to the overbidding. The overbidding, the magnitude isn't that great because it looks like it's 103%. And you come back here and in 17, you're at 107%. But the frequency of overbidding is pretty strong. The only year that outbids you is 17. And the reason for that sort of apparent discrepancy, again, is people are more hesitant to overbid after the insult. You come down and you look at sale price, we're at $14.50. $1,450,000 is the median sale price for single family homes. Also coming down to look at the square footage of the homes down here, you're at $18.57. And if you look back, we've never had a square footage that big. So again, that's an indication that people are trying to get a little more square footage because the typical house that is selling now is almost 100 square feet bigger than it is for most of these historical months. So that you can see it in the data. Now we're looking at a semi-log plot of the price, and you can see there's no downward price. This is the 10 percentile. This is the cheapest 10% of the homes in Santa Clara County. The median price that most people follow, way more stable. And then the 90 percentile, because it's the top end and it does fluctuate a little bit more, but you can clearly see there was no dip down from shelter in place. It's been an amazingly strong year and we've been having some appreciation. This is the same data in the standard graph that people are more used to doing. These horizontal lines were the previous peak. You can see everybody's above their previous peak, so it's time to get rid of those lines. But again, yeah, you can say the price came down, but at the high end, that's just monthly fluctuation. The median, you can see, is pretty rock solid, and if anything, trending up. The 10 percentile is basically fairly flat, as you can see. Now we're looking at both the magnitude and frequency of overbidding. We'll start with the fuchsia line down here, and this is going to be the frequency of overbidding. What percentage of sellers getting more than their asking price? And if you look across, you can see it's at 65%. County macro data, I was saying the number was at 60%. How do you explain the difference when Santa Clara County single family homes is the biggest one? Basically what it says, this is pulling up. So this is like half of the whole thing. It's at 65. So the combined thing, when you add the other 50%, which would be San Mateo County single family homes, condos in San Mateo counties, and condos in Santa Clara County, if it's 50-50, and that's not 100% accurate, that would tend to say that those areas are getting only overbid at about 55%. So when you take 55% and the 65%, you average them together, the weighted average essentially, and you come out at 60%. But you can see the fluctuation here because of shelter in place, and it came up. So, here was the big disruption. And what would have happened had we not had shelter in place? It probably would have come up and would have been fairly flat, sort of like we had back here in 2017. Going up to the magnitude of overbidding, you can see, if you go back in time, the magnitude of overbidding is clearly over 105% when you're way up here in the 60-70% range. Here, we're only at 103%. So again, that's reflecting the buyers being hesitant to overbid. But again, if you're getting 3% above your asking price, you really cannot be complaining. This is a nod towards the stock market. It's the price decline ratio, but instead of doing it on the number of units like the stock market does, it's just a ratio. I don't think it's that valuable. I probably will get rid of it. This graph is very valuable. The blue line is probably the most interesting data, in my opinion. That's my quote, days of unsold inventory. You can see how rapidly it increased with shelter in place and how rapidly it improved. You can see on a monthly basis, it still sloped down, which is an improving marketplace. Anything below 40 days is what I consider to be a very strong seller's marketplace. I call this a balanced marketplace, but it's not like you cross over and you automatically shift. It's a gradient over the whole process. Now what we're looking at is the 12-month moving average, except for the purple line, which is the days of unsold inventory. So if you look at the blue line, the light blue line, the ice blue line, that's inventory. So you can see inventory came way down in 2017. It recovered in 2018. Then it's been coming down in 2020. The reason this is so smooth, again, is I'm doing a 12-month average. You'd almost expect it to be flat like it was through this period of time. That's basically saying your market's well behaved. It's not really changed from a year ago because you're deleting, now we'd be deleting October of 2019's data and adding in October of 2020's data. So for the inventory to be coming down like that, that means inventory is now lower than it was a year ago. If you move on to the red line, which is offers accepted, you can see the impact with shelter in place, but now you can see it's been increasing. So we've been increasing the number of sales. So we're selling more homes now than we were last year, and the closings fall behind that. The discrepancy here is basically the percentage of transactions that fell through. So you can see that there have been times when it's been very limited number of transactions that have fallen through. We're a little bit stronger now, but we're not anywhere close to what we were during the buyer's marketplace after coming out of the recession, which is why the red line is so much above the gold line. You're always going to have some buyers that are unable to get their financing. So they're never going to be more closings than sales after you adjust for the time lag. Now we're looking at the single family homes. So you can see Santa Clara County, it's really pulled away. It's lagging at the top end, like I explained before, because people are a little more hesitant to overbid. But we're having the second best October in Santa Clara County single family homes that we've ever had. That is with shelter in place. So not only is volume of homes up, the amount of overbidding is up. And here's just the last 12 years so that you can see it a little cleaner. And again, 2017 was a major outlier. Basically from about August of 17 through about May of 18 were just unbelievable marketplace. So we'll never probably achieve those again. And then what we're doing here is we're looking at sale price at 10% to the median sale price. So the 10 percentile price is obviously a fraction of the median price, which is why it's down below 100%. And you can see at this point where the lines got closer together, you had price compression. So at this point, the 90 percentile price was twice the median price. The 10 percentile price was something like 77% of the median price. So you're fairly close together. You can see then we got into the mortgage meltdown and the stock market meltdown, and you had price expansion. The vertical separation got much greater here. And now you can see we've been having a little bit of price compression. Part of what was going on here is we had the liar loans where you could put no money down and they didn't verify your income. And so that got rid of the barriers to entry. So we had a super inflated lower end of the marketplace. You know, they got rid of the barriers of entry. Buyers flooded it. There was more demand than supply, causing the price on the low end to go up. And with that, we're finished with the monthly data. I'll take any questions.
Yeah, well, maybe we can look at the previous page and see the historical trend. So this one, yeah, this one I think it's very interesting that you're saying the 2008 is the the mortgage meltdown. So yeah, I just wanted to.
Well, the mortgage meltdown actually happened in February of 2007. So that happened right here. So you can see at that point, the low end of the marketplace, the 10 percentile dropped in value compared to the median.
Okay, and so there's more foreclosures at that time. More foreclosures on these homes.
The foreclosures weren't happening yet at that point in time. It was just buyers were not buying because they couldn't get financing. The liar
Oh,
loans,
okay, I see.
the liar loans went away, and so buyers couldn't buy, and that happened very dramatically in February of '07. But you can see the high end actually went up, and it did better because
Yeah,
the stock market didn't happen until August of 2008. But
okay.
even then, at that point, both the high end and the low end were suffering. So they stayed at their new separation for quite a bit of period of time. And it basically is probably in about 2013. Well, even on the high end, maybe in 2012, the high end, you might argue, was coming down a little bit. But in 2013, the low end started to come up a little bit. I've been actually a little surprised that the low end hasn't come up a little bit more. I would expect this number to be about 68%. And I don't know what the number is, but it's probably only about 60, 65%. And that's not huge. I do believe this number here was already overinflated, so I don't expect to ever get back to the 10 percentile being 75% of the marketplace. But, back here, that's a little closer to where I'd expect to be. And, maybe it's not huge, but this number here to me looks like 68, 70%. And this number over here looks more like about 65%.
Yeah, so just wanted to see whether, I can see the next couple of years, what it will look like.
There's no way to predict the next.
Yeah, I know.
No way to predict the next couple of years. I mean, the best indicator of what the future of the market's going to do is the days of unsold inventory, and that only gives you at best about 75-day lead time, and that's just
Yeah.
straightforward economics. We're in a quote unquote free economy, so supply demand dictates what happens, and
Right.
when your days of unsold inventory is decreasing, that means there's more demand for the inventory. Your inventory is essentially decreasing, and that creates prices to go up.
All right. Yeah, that's it. Yeah, I'm fine, if
Okay.
you want to stop here.
I'll stop here because I think the summary is pretty good. We went into the monthly stuff, and we come back next week when we only do the.
Thank you so much.
You're more than welcome. Thanks for joining.